So this playbook seems to make a lot of sense, right? Jerome Powell being put in an uncomfortable position with the shadow Fed and then resigning early, giving the job essentially to the next guy. The next guy gets in, Fed cuts rates, bond market doesn't like it, rates go higher. That's a big, big mess. Not very good. Could Jerome Powell resign in the next 30 days? Folks, I think this might be a real possibility. I think this will have impact on interest rates, your money, the market. So let's break it down. Let's talk about it. Step one, it appears that President Trump will very shortly be nominating the next Fed chair. Now, if you don't know, currently Jerome Powell is the Fed chair. His term as the Fed chair is supposed to end May of 2026. So he is, let's call it 11 months from his term as Fed chair being over. As we all know, President Trump has called him Mr. Late. He is not happy with the Fed keeping rates where they are. More on that later in the show. But again, President Trump tried to kind of make it seem like he was going to fire Jerome Powell about 6 to 8 weeks ago. The bond market let him know that that would be a mistake. Scott Bessent let him know that would be a mistake. So President Trump has been looking for a more soft play to get Jerome Powell out. Because, of course, let's be clear, President Trump wants the Fed to lower rates. In fact, yesterday we talked about the fact that Trump wants the Fed to lower rates a lot, i.e. 100 basis points in an emergency move. The Fed is not going to do that under Powell's current leadership. So what is going to happen? Jerome Powell is going to nominate someone, perhaps like Warsh, who will be nothing more than a puppet master to the whims and desires of President Trump. Now, this nomination by itself may be uncomfortable for Jerome Powell, but here's where it becomes a problem. What they are going to do with the next nominee, and let's assume it's Warsh for a minute. Again, it could be anybody, but it will be a lapdog to President Trump. There's no question. Warsh or whoever it is will be going all over the news networks every single day, Monday quarterbacking every Fed rate decision. And of course, all of these discussions will be the Fed is wrong. I wouldn't do that. The Fed this, the Fed that. And pretty soon, Jerome Powell could very likely go, okay, I've had enough. I don't like where things are going. I'm going to resign early. Okay, again, Jerome Powell may choose to stick it out. It would be extremely uncomfortable, not a lot of fun, and frankly painful. I mean, like, why bother, right? Jerome Powell's already rich. He's already got, enough money to do whatever he wants, get on the speaking circuit. Why would he want to deal with this for 10, 11 months? But here's the problem. If President Trump were to execute this shadow Fed, and the shadow Fed will make the current Fed president resign, I suspect we will get the same result. The bond market will not like a Fed president who is a lapdog to the current administration. What does that mean for you and I? Well, quite simply, long rates go higher. Let's not forget that we already have examples of this. Do you guys remember that Jerome Powell cut interest rates, or the Fed rate, 100 basis points before the election? Remember that? Trying to, by some accounts, help Biden or Kamala beat Trump, right? Cut rates before election. Didn't work. But the real problem was mortgage rates went up. I think mortgage rates are up 90 to 100 basis points, and the Fed cut. So just because Trump gets his lapdog, just because Warsh or whoever he picks is the shadow Fed, Powell resigns, you may not get what you're looking for. The 10-year and 30-year bond market interest rates could absolutely go higher, even if Warsh or like nominee gets the job. So this playbook seems to make a lot of sense, right? Jerome Powell being put in an uncomfortable position with the shadow Fed and then resigning early, giving the job essentially to the next guy. The next guy gets in, Fed cuts rates, bond market doesn't like it, rates go higher. That's a big, big mess. Not very good. Other things going on in the news, kind of 5 things to talk about here. Looks like the Chinese and American trade talks are continuing over in London. That can't be seen as anything but good news. Looks like China's economy is really struggling. China's exports dropped 34.5%. Again, please remember China is a export-led economy. So again, Chinese exports down 34.5%. Also, it appears that China is stuck in a deflation cycle where prices are going down. This happens when an economy is sick. An economy is heading towards a depression. CPI in China is down negative 4 months in a row. The Chinese are not stepping up and having consumption. They're not consuming. They are saving. They are conserving. So again, China has an economy that is shrinking. So again, exports drop, CPI drops, PPI drops. It is a very uncomfortable economy currently. Saw an interesting report from the Lethal Group. It's a private equity group. They say that equity managers are acting like there is no recession risk whatsoever. Obviously, we've seen the stock market S&P rip higher, and I think it's within 2 or 3% of a 52-week high, an all-time high, frankly. And again, saying that the current market is over-indexed, price to perfection, all of those things. Some interesting stuff. Getting some interesting data on inflation. Remember, folks, we get CPI. We get CPI this week, and as we talked about yesterday, CPI is expected to go up, not down, up, not down. Again, it's expected to go up 0.2% from, I think it was 2.3 to 2.5. Core is also expected to go up. Then we have things like analysts saying tariffs are going to increase CPI for the next quarter or 2. So again, we are very quickly getting to no rate cuts in 2025. This is, of course, one of my bold calls earlier in the year, and it is looking more and more likely. Again, I've been warning you about the next 3 months. This week is the first of the 3 months where even if we didn't have tariffs, CPI would look like it's going higher. CPI and inflation is only going to get worse for the next couple of months. It is a mathematical certainty, and just wait for all of the news networks to catch up. Morgan Stanley, I think somebody at Morgan Stanley must be watching this channel. Shout out to all the Morgan Stanley employees. They are now saying we are not expecting any Fed rate cuts this year. In fact, we expect inflation to pick up over the summer, i.e. the next 3 months. And then tariff impact in question. So again, Morgan Stanley has taken a lot of stuff you and I talk about daily and now made it their call. Don't know if you saw Ben Mala on the Iced Coffee Hour, but shout out the Iced Coffee Hour and Ben Mala. What is Ben Mala doing right now? I'm lowballing, baby. I can't really act. I don't have that smoker's throat like Ben does. I'm lowballing, baby. That's exactly what we do here. Again, remember, I call it disrespectful offers. Take your shot, follow up, go for it. Again, Ben Mala is trying to get active, but buying stuff cheap. That's what all of us should be doing in this environment, is seeking out motivated sellers who have to sell. Jeremy Siegel's out on CNBC today, again, saying the Fed has room to lower rates. Jeremy, what are you talking about, man? We're about to get 2 to 3 months of inflation increasing, and you want to cut rates into increasing inflation? Isn't that ass backwards? I don't know. It seems like it is to me. We had a significant bankruptcy filing in the solar arena. Sonova filed for bankruptcy yesterday, I believe. They're laying off 55% of their employees. That equates to 718 employees. Looks like the job market is trash. This according to Mandy Santos, a career coach, especially for college grads, new college grads. Pay attention. New college grads, for the first time in 25 years, the unemployment rate for new college grads is higher than the national average. The current unemployment rate for new college grads is 6%, where the national average, of course, is 4.2. Here's the deal. If you are a new college grad and you get a job offer, take it. Take it. It is easier to get the next job when you have a current job. Always remember that. Just want to let you know that we did do 2 hours. We did 2 hours in the school community with Dion, Financial Talk, and Matt, the lumberjack landlord. That 2-hour video is only on school. Inside that 2-hour video, we talked about some stuff that we did not want to put out on YouTube for the masses. So we are keeping that inside of school. Again, if you want to be a part of these conversations, I look to invite people every Sunday morning. You can come and participate. I think we had 50 or so people on the show Sunday morning. We went for 2 hours. If you want to watch them on replay because you can't watch them, it's okay. If you are a school member, it is already loaded. And I sent an email out to you, or a comment. I sent out a comment with the link there. So again, we talked about lots of things. We talked about negotiating with motivated sellers. We talked about different markets like Orange County and others. We talked about when to go get private money. We talked about leveraging equity. We talked about the first 5 years sucking. Lots of people had great questions. Again, some very specific stuff we didn't feel like putting out in the world. So if you wanted to see it, you got to be a part of school. Again, school is 67 pennies a day. You get in school for one reason and one reason only. You are a wealth builder. You are trying to build wealth for you and your family. Our school platform is where wealth builders go to grow and network. You've got 6 or 7 different masterminds, accountability groups, free education, training, and access to millionaires. No better place to go. Join school today, one rental at a time. You won't regret it. What else do we got to talk about? Oh, let's talk about the dirty jobs number. So I was reading a bunch about Friday's jobs number, which again, on the surface looked good. It was a big beat, 139 on an expectation of 125. But as always, sometimes you got to go below the surface and look at the dirty, dirty numbers. Number one, 600,000 full-time jobs look to have been lost. Participation rate fell dramatically, thus canceling out the loss of jobs. And of course, they had the birth death adjustment, which added 199,000. So again, I think the Friday jobs number was, frankly, the best it could have been. It could have been a lot worse. In fact, it could have been negative. It could have been negative. I'm going to see if I can do the math and report tomorrow, the math, and see if it would have been negative if the participation rate stayed flat. I'll look and see if I can do that for you. So there you go. Lastly, we'll close. Oh, 2 more things. We'll close out with Goldman Sachs. So let me talk about Larry Fink first. Larry Fink warns that the $36 trillion in debt, obviously referring to our national debt, is going to overwhelm America. Folks, that's not good. Unless, there's always an unless, we have stellar economic growth achieved. What I've seen from the administration with this big, beautiful bill is we have given up on cutting. Instead, we are going to try to create a growth-oriented framework and grow our way out of this. This is Scott Bessent's famous 3-3-3 strategy. Larry Fink is saying that's the only way out. And then finally, we'll close on Goldman Sachs as they have their new housing predictions. Everybody loves housing predictions. First up, mortgage rates. This is a significant change for Goldman Sachs. Goldman Sachs now says we will end 2025 with interest rates at 6.75. Call it, a quarter below where we are today. That is a significant move. At the early part of the year, they thought mortgage rates would end 2025 at 6.1. And then finally, home prices. Everybody wants to know home prices. Goldman Sachs says for 2025, the national median home price will end up 3.2%, not down like some folks are calling. And lastly, folks, let's congratulate two people for joining school, Isaac and Jasek. Thank you for being a part of school. Make sure you introduce yourself, get all the free educations, network. And then again, remember, folks, if you are a wealth builder, if you are looking to build wealth for yourself or your family, join school. You won't regret it. 67 pennies a day, and you will be around other wealth builders. Network, grow, learn, encourage, ask questions, get involved with other millionaires. And folks, have a wonderful day. Like, subscribe, comment. Don't forget that Steadily is landlord insurance, somebody I am using for 4-plex, 10-plex, some houses and the like. If you are a landlord and you just want to see what's what, go to the link in the description and see if they can help you provide better coverage at better rates. If you're brand new and you're building out your Excel spreadsheet, go get one of your addresses, put it in Steadily's online form so you have accurate numbers. Folks, take care of yourself. Have a wonderful day. Later.